and provide you with their take on the current state of the market, how they may be seeing changes in investment strategies, and probably quite a bit of follow-on from our conversations earlier this morning. Our panel this morning is moderated by Steve Quazzo. Steve is the co-founder and CEO of Pearlmark Real Estate, based here in Chicago. Since inception in 1996, they've made more than 530 investments nationwide, totaling approximately $13.2 billion. In his previous life, Steve was president of Equity Institutional Investors, Inc., a subsidiary of Equity Group Investments, and also served as a vice president in the real estate department of Goldman Sachs in charge of real estate investment banking in the Midwest. So Steve is clearly more than qualified to moderate for the rest of our esteemed panel. I'll turn it over to Steve.
Awesome. Thank you, Kara. And thank you, DLA. First of all, by the way, the gentleman in the back is fine, in case for those of you who were there. It was kind of a disquieting way to end the last panel. We're going to try to pick up on where that panel left off, because I thought they did really a great job in sort of setting the stage and being sort of the big picture visionaries. I think on this panel you have people who are a little more in the trenches and are more real practitioners and tactical investors. And so we're going to try to get a little bit more granular. But DLA's been doing this conference, I learned last night, for 15, not years, but every 18 months. And I think I've been to most of them, and they've been phenomenal. So, Jay Epstein, Joy Carlson, and the team, and Kara and your team for coordinating this panel, thank you. So our title today is Investing Capital in Times of Change. Basically, it's the same panel we do every year. DLA creatively changes it, but I'm going to synthesize it for you. It's basically money and deals, okay? That's really what we do. How do we marry the needs of the investor today, which, and it's always changing, with the challenging environment for finding good investment opportunities out there in real estate? And that's really what we want to talk about. A couple of comments. One, I don't care what the environment is. It's always hard to raise money. And it's always hard to raise discretionary blind pool money, unless, of course, you're Blackstone, that just raised $22 billion in their fund, and last month in their BREIT raised $1.1 billion. I mean, $1.1 billion in 1 month, staggering. So that's, and actually the implications of that are not good for people like me, because that's a big sucking sound, pulling capital out of the market. But so it's harder for the rest of us to raise discretionary capital. And then obviously on the deal side, on the investment side, I mean, it's competitive out there. There are a lot of people hustling, looking for opportunities. We hear about the wall of capital, trying to find a home. So how do you navigate that? How do you find things that make sense? Fortunately, we have an all-star group here today of real pros. And it's really a very diverse group, and I'm not talking about gender diversity, which is a happy byproduct, and we'll talk about that later. But I'm talking about just diverse in terms of product types, niches, scope, where within the industry, these guys are all playing, their ownership structures, which we'll talk about. So I think, we want to have a discussion. It's kind of a more intimate group than in there. So start thinking of questions. I want to leave lots of time at the end, because I really don't like hearing myself talk, and so we want to open it up. Why don't we start, because nobody reads the program on the bios, just give just a quick intro of your organization, what you're doing, and then we'll get into the meat of it. So I want to start with you, Toph.
All right. Well, first off, I want to recognize and thank my man Jesse Kriz at DLA for all he's done for us and helped us build our business. So Jesse, it's great to see you. Thank you for everything, my man. Great to see you. So Harrison Street, started the business about 13, 14 years ago, and the theme for us was around education and healthcare real estate. We also invest in storage. And fast forward today, that's really all we've been doing. It's sort of boring. We've just been focused in those sort of demographic asset classes. And so we've invested now upwards of $28 billion in those asset classes, about 1,000 properties around the US, Europe. I think our AUM is about 22 or 23 billion right now. We've had an active year. We've raised about 4 or 5 billion of capital, most of that discretionary, so we've been very fortunate. And for us, again, our specialty has been around these sort of alternative asset classes. And you know, what's fun about it is 10, 12 years ago when we started, it wasn't much of a topic. And now you're seeing most companies in some form or shape are talking about adding these asset classes in their portfolio. So it's been a lot of fun to see the industry evolve. 150 people based here in Chicago. We also have an office in London as we expand our European business.
Perfect. Pam?
So I'm Pam Herbst. I am a managing director at AEW Capital Management. We are a global investment advisor with about 80 billion under management. We've been around for about 40 years, so we've been in this industry for a very long time. And in the U.S., I run our direct investment business, which is Core and Value Add. I'm fortunate to be joined by my colleague, Mark Davidson, who runs our Opportunity Fund, so any tough questions, I'll throw over to him. And then we also have a public securities business. So in the U.S., it's around 38 billion of AUM, and so I represent 30 billion of that, which is all Core and Value Add. It's in funds, and it's in separate accounts. So the property types that my group covers are the 4 major property types plus senior housing. We do equity, and we also do some debt through a separate account. And so I've been at this company my entire career, in the predecessor company we merged with, so I've done pretty much every job from acquisitions through asset management to portfolio management, and spend most of my time now managing people. What a great job. So anyway, I look forward to your questions and Steve's questions.
Perfect. Susan?
Thank you. Happy to be here. Susan Swansea, a partner at Hodes Weil and Associates. We are a real estate advisory firm that focuses just on the real estate investment management industry. So I'm trying to give the perspective of capital today. We are headquartered in New York, have offices in Denver, but also London and Hong Kong. So we have a global perspective. And just as a teaser in terms of, I would say 60% of the capital we raise is either non-US strategies, non-US capital for US strategies or US capital for non-US strategies. So that's something we can talk about in terms of where the capital's coming from. 34 people. Capital raising is what we're most well known for, and but we also have a real estate advisory firm. We started out doing a lot of. Back in 2009, we started our business. There wasn't a lot of capital raising to be done, but we did some strategic advisory, fund recaps, orphaned operating partners, trying to find them a new home. And it's migrated to more M&A on the advisory side, given the consolidation in our industry, which is something else we could be talking about. And then we also have some capital to invest in. We put minority stakes in managers that we think are well positioned to grow. We are agnostic about, we do fundraising, but we're agnostic about the structure. We listen to the manager, what's the strategy, what's the hold period, and then we recommend whether it should be a fund, a separate account, a programmatic venture. So we'll talk about vehicles too.
Excellent. Randy?
Green Court Partners, based out of Chicago. We are 17 years old. About 50 people in the headquarters group, about 3,000 people out on the operating platforms. We build operating platforms in niche sectors, manufactured housing, near airport parking, senior living. We raise a fund every 3 years or so. We just closed on our latest fund last Friday, a little over 500 million. And we pretty much get up every day and just try to make the operating platforms better in each of our spaces. And the exit strategy down the road is either you take it public or you sell it as a combined enterprise.
Great. So set the stage here. Interest rates, pretty much all-time lows, and as we learned earlier, negative real rates, even here in the U.S. Unemployment, lowest rate since, post-World War II. GDP growth, 2.5%. If we could solve our immigration issues and China tariff issues, obviously it'd probably go more. Supply and demand in real estate, pretty much in balance, good shape. Relative returns, real estate looks like a winner. So, what's not to love? So maybe start out, just give kind of with that as a backdrop, kind of your macro view about the world, and end with, are you pessimistic or optimistic about the next 18 months? Give us
Okay.
a start.
So interest rates, I mean, basically money's free, right? And probably 60% of our client base on my side of the business is core, and the rest is core plus value add, whatever you want to call it. Probably one of the best strategies to employ is leverage core, but in the world of core investors, they don't like leverage. Right? So it's a little crazy to think that a lot of the institutional investors would rather use high leverage on very risky, opportunistic strategies, but they don't. So it gets difficult because when I look at low interest rates, it concerns me on the core side because it's already incredibly tough to compete. And I'm concerned that more value add and opportunistic funds are going to be competing against our core capital. I mean, we've already seen it, and it started to beg off a little bit as rates started to go up, and now that rates are down again, it's just a concern that we have. At this point in the cycle, for core money, we're really focused on quality. So if you take a look at our portfolio, we have been probably less bullish on office. A lot of that has to do with just the cost of capital for both just improving buildings, because a lot of people starved their buildings coming out of the financial crisis, and just the cost to bring tenants in is just getting, incredibly high, on top of everybody wants really kind of a hospitality type feel in an office building. So we haven't been as bullish on office. That doesn't mean we won't do it, because we have to have diversification. So we really are focused on markets where there will be job growth and newer property types. On housing, overall, we're just really bullish. I know a lot of apartments have been built in the US, but we still feel really good about housing. A lot of young people do have an incredible debt load. And so one area that we are focusing on is more kind of ex-urban apartments instead of urban living, because rents have gotten to the level where they're just incredibly high. So we actually think going into some of the ex-urban markets with great schools and expensive single-family homes is a great opportunity. And candidly, they're the more difficult markets to build in. So we think supply will stay in check.
So in the last panel, they were talking about dialing down return expectations. Last week when we were together, you talked about the expectation for core real estate over the next 5 years.
Okay, so
share with this group.
Yeah, so hold your seats. PREA does a survey of all the plan sponsors and people like us, and says, what do you think returns are going to be for core real estate over the next 5 years? And the forecast is 5.5%, with most of that coming from income. It sounds crazy because our investors got used to having really terrific returns coming out of the financial crisis, right? So the 10-year return on NCREIF, which is the benchmark that gets used, I think, is about a 9.5 over a 10-year period. So core clients at first were like, what do you mean the return's going to be an 8, a 7.5, a 7? It just kept going down. But I think now, through a fair amount of education with new entrants into the capital space, they're understanding that historically, 80% of the return on core real estate came from income anyway, and that core real estate really was supposed to be a long-term investment where you got diversification, it was inflation hedge, and all those good things. Yeah. But that is what they're really looking at. And for the first time I can remember, they actually are projecting some depreciation in the index, which I had never seen before, and it's primarily for retail, right? But the bottom line is, if you look at NOI around most property types today, it still looks pretty attractive, with the exception of retail.
Right. Yeah, I think there's been, Deb, we talked about this too, an increased focus on cash flow versus NOI.
Great point.
And as we look at office in particular, that number can be very variable.
Yeah, I mean, that's actually a really interesting point, because for some reason in our world, they also look at income yields and not cash yields. And we focus a lot on cash yields. And if you look again at the index, in the office portfolio alone of NCREIF, about half of the income yield is spent on improvements. So the cash yield really is equal to the 10-year.
Right. So next 18 months, optimistic, pessimistic?
I'm kind of neutral.
Okay.
Right? I don't know that things are going to get worse. I don't think things are going to get better. but I just don't see anything that, says disaster. And as our head of research always says, recessions don't just happen, right? There has to be a catalyst, so I have no idea what it is.
We'll come back to that.
Wait,
Let's
can
get
I,
some-
can I, 'cause
Absolutely, yeah.
let me go, I'll go a deeper dive. So to me, when you look at sort of the fact pattern, you look at these Odyssey funds and the data that's coming out of these funds, absolutely 80% of these funds were supposed to be about income. But if you look at the past 3, 4, 5, 6 years, it was almost reversed in terms of how much appreciation was coming out of these funds. And so when you think of the Odyssey funds, they're 40% office, they're 20 to 30% retail. You've got to be more than 80% what they call core assets in order to be part of the Odyssey Index. You're starting to see that, that negative appreciation number. And so we've seen the past year, whatever sentiments we might think, we're seeing the investor community is starting to increase redemptions to these funds. So certainly the investor community is starting to get more and more concerned. When you look at the type of returns, it's sort of how are you going to get those returns when you're in 5 cities with office, you're in retail, et cetera. So we're starting to see a lot of people sort of say, okay, where do I want to put the capital for that next 10 years? And so people are starting to think more about other strategies, whether it's what we're doing or it's the debt, it's infrastructure, et cetera. We're starting to see people really thinking about, okay, how do I get my capital a little bit more defensive? And so I think that's a discussion of what is core. Is core about the asset class, or is core about the type of assets and the strategy and that you're employing? So it's been interesting to see that.
Well, I want to come back to the investor perspectives, but first let me jump over. Randy, give me kind of your perspective. You run some interesting businesses, senior housing, manufactured housing, parking. How are you seeing from a macro and drill down a little bit?
Well, late cycle, we always see people coming into the niche sectors. People start running out of other things to invest in. They start looking more broadly. And this is not any different this time around. And so as an example, in manufactured housing, if it's fully leased and it's pretty, the cap rates have been driven down in many cases below 4%, because people perceive them as being very safe and very secure. And they probably will weather the downturn better than most things. So in order to generate returns, we have to move more into a value-add strategy. We're doing, we bought a property that 659 sites, 200 vacant, terribly abused by the previous owner. We're going to take another 100 homes out, so we'll ultimately replace or fill 300 homes. We'll redo the roads, which we just did. We redid the clubhouse. We did all the public spaces, the swimming pool, the playgrounds, the basketball courts. And when you do that, it will generate the return, but you need to have more human resource allocated to those deals. And so you find that you can't do as many, so you have to be very careful that there's enough scale to it to make it worth your while, and be very, very confident that the return will be there. In that case, we bought the asset for $28 million. We're going to put another 12, upward maybe 14 in it, and then we'll have a $70 million asset. So that's the kind of thing we find we have to do in the MH. In the senior space, there's just a lot of development going on, and so we're having trouble making sense of replacement cost. So there we're tending to buy 10, 15-year-old assets, and we're doing renovation, much lighter renovation than what I described in the MH space, and positioning ourselves at a good discount to replacement costs so we can feel that we have some room to move on the rents. And then in the near airport parking business, we have the advantage of being double the size of the next player. And so there we've been able to keep buying traditional assets. Typically the seller thinks they're getting a 5.5 cap, and we believe within the first 18 months of operation we're getting north of a 7. So that's just the advantage of scale of having that in that business. So that one's been the least impacted by what's going on. But clearly there's a lot of money competing across all the verticals, and it's no different in our spaces.
But so given that you're doing development and heavy value add, I assume your view of the world, given the lead times associated with that, is fairly positive or at least stable. I mean, you don't see any warning signs.
I'm relatively neutral, but in the manufactured housing, we're mostly doing family communities, and affordable housing will be an issue no matter where we are in the economic cycle. In the case of the one I described, Warren Buffett's building a new intermodal facility with 17 million square feet of distribution and 11,000 new jobs 4 miles from the property, and there is no housing. So we're very comfortable that we're going to have a good demand wave coming at us.
Great. Susan, you guys are maybe the premier firm in raising capital and are certainly kingmakers or queenmakers out there in terms of selecting managers in which you will either take a minority stake in, as you mentioned, or raise money for. And I don't know how many potential money-raising assignments you see a year versus how many you pick, but maybe talk a little bit of kind of your view of the world and how that shapes which ones you select and what strategies you think resonate and make sense.
Sure. And just for perspective, we probably meet with 250 managers a year, and that's in all our offices, and we work on 6, 7, or maybe 8 new strategies a year. So we're highly selective, and some of these mandates can last for a year, year and a half in terms of getting the manager ready to go to market and putting the offering materials together and formulating the strategy and the structure and then the actual marketing. And so we can, depending on the vehicle, it can be quicker, but we can be in the market for a year or 18 months. So and we have a limited amount of slots. So we're highly selective in terms of, and have to have a lot, high conviction. So, and consistent with Chris said in terms of, investors are defensively positioned. There's no question about it. They've been that way for a couple of years. That's not new information. But what does that mean? It means, especially late cycle, it means a safe pair of hands. They really want them. They want to have trust and confidence in the manager, in their experience, in the depth of the team, and the track record, and the platform. They're looking for. Even if it's an opportunistic strategy, we're hearing what percentage of your return is coming from income. So it's, again, that's just to de-risk. They don't want it to be totally residual weighted. How to use debt. I mean, they're really digging in, not just the leverage level, but how much recourse. Do you cross-collateralize? And they're going to look for limits on those kinds of things. So it's a much more extensive due diligence process than it has been in the past. So from that, and durable cash flows. That's the thing that's very important. Either you're going to buy them or you're going to create them. But if you're going to create them at this point in the cycle, similar to kind of the strategies that you're talking about, if you're going to develop them or have a deep value add, can you get it done within a reasonable period of time? Because there isn't a lot of confidence about, the recession or the correction is coming. So we don't know when, but we want to make sure that it's not kind of a long duration play. So what does that mean in terms of the types of strategies? We've seen a lot of investor interest in niche strategies, not surprisingly. I would say that doesn't mean that there isn't a home for diversified strategies, and there are some very well-established managers that have huge followings, and investors today are precious guardians of their resources, and so they're going to they have been reducing the number of managers, and they want to do more with the managers that they work with. So Harrison Street has been very successful in focusing on alternative sectors and demographically driven strategies, and has an opportunistic business and a core business. And so that's something that we're seeing more managers do, being able to leveraging off their relationships. So you can, for us, if we're looking at what are the mandates that we're going to take on? It's going to be those sectors that are complementary to kind of the established diversified players. And so we have, and talking on some of the strategies we've heard mentioned today, we took on a life science strategy 2 years ago that was very successful in a programmatic venture. We're actually working on a co-living strategy, which was also mentioned this morning. We also have student housing that will be a fund, senior housing, which is going to be a programmatic venture, some sector-focused strategy, and a industrial strategy in Europe and the UK. So it's definitely more sector-focused, niche-ier strategies as investors are looking for, whether it's demographically driven. They view that there's a longer runway for those strategies.
Since 2009, we've seen amongst institutional investors kind of a de-emphasis of these big blind pool funds, diversified. Yet, you look at our panelists here, and all of them have been incredibly successful at basically raising blind pool capital. What are some of the trade-offs? What are some of the trends? What are you seeing amongst investors? I mean, you're hearing a lot about separate accounts or co-invest. Give us a sense.
There's a blind pool risk is definitely a risk, especially for a manager that doesn't have his third, fourth, fifth, 12th fund. And so one of the things that we're seeing investors really like it when there's some seed assets in a fund or programmatic venture. So to the extent that you can figure out how to, if you've got the capital to seed a couple assets, what we're also seeing is investors are very interested in co-investment strategies, and so some of these structures get pretty elaborate, where some investors will say, okay, I'll go in your fund, but I want a sidecar so I can co-invest with each one of the deals, but. The co-investment strategy has been around for years, but it's really gotten traction. And as a result, what we're seeing are investors that had been typically, maybe 3 or 5 years ago, were typically pure fund investors, are now they're probably 50% direct and 50% co-investor or 50% fund investors, and they're going to go into funds in strategies that they can't access on a direct basis, which also kind of sort of feeds our niche-ier strategy focus. So they can do more in kind of the major food groups in separate accounts and programmatic ventures, but they'll do funds in strategies that they can't access.
So let me go down the line here, since each of you have recently raised funds. Give us some color, some anecdotal. What are you hearing from investors? How do you kind of win them over? What's been the, sort of the success ingredients?
And we've had some multiple funds. So we had an opportunistic fund in the U.S. We just closed on about $1.6 billion. We have 2 open-ended funds around the education healthcare space. We also do a new social infrastructure strategy, and then we have some closed-end funds in Europe. So we've gotten exposure to different investors, I'd say, around the globe. And really, we got pretty lucky with this whole thing. When we started this business in 2005, it was this idea of trying to be different and create some sort of innovation in our business and try and go to a place where other people weren't. And so we started this thesis. And so I'd say a lot of the fundraising is really born out of just luck. We happened to hit on asset classes that did really, really well in the recession. We've now built a team of really true domain experts. So, I think what sells our products is we can sit in front of someone and say, yes, everybody's talking about these sectors now. Yes, everybody's coming into the spaces now. But we've done $28 billion. We've got a team of 150 people that are experts in the space. We don't just have one partner. We have 70 or 80 partners. So it's really these relationships we've developed. We're at 170 universities. We have 30 to 40 health systems we work with. So it's this relationship, the people, and then the experience, because we've made a lot of mistakes. And frankly, that to me is really when you sit in front of someone. The early days we'd talk about student housing and they'd say Animal House, they'd say who's buying from you, this makes no sense, you're nuts. Senior housing is too operational intensive, there's no way it works, skilled nursing, the differences. So, we heard so many no's and no's and no's, but now we're in pitches and, you flip over the pages on student housing and you just sort of get into your experience. And so for me, it's been luck. Frankly, we picked a good space. We got a great team. We've done a lot of this stuff. I think, we've tried to be as open about the mistakes we've made to our investors. And then to your point, there's a huge consolidation right now. And so you talk to an investor and they're saying, look, I've got 20 managers. I got to cull it down to 10. So you know what? They're not going to get rid of Blackstone, so you better be able to offer them more products. Yep. If you can't, you're going to be one of the guys that's going to be called. So you've got this interesting thing going on now with this huge consolidation. And so again, I think for us it was, right strategy, experience really, I think, helped us in the market today.
Tove's very modest. Lee Trevino once said, the harder I practice, the luckier I get. So
That's right.
It comes a hard word. Pam, talk about
So-
AEW. You don't get to 80 billion without
Well,
having
no,
some
no.
success in fundraising.
You know, fundraising, first of all, is incredibly hard. A lot of people don't fully appreciate
glad
that.
you
It
agree
takes-
with me.
takes a lot of years to raise the money. I think one of the benefits that AEW has had is because we have a broad-based platform, which started in the U.S. We didn't grow into Europe until 2000, and then after that Asia, and so those will look very much like we are in the U.S. But the truth of the matter is we have clients that we've been representing now for 30 years. A lot of them in separate accounts, because that was really the history of the company, and then it was the Opportunity Fund, and then it was doing core separate account, which then became an open-ended core fund. We started senior housing actually on the Opportunity Fund side, and then did a separate account with a big public fund, and then started the fund series. So we have clients who have gone from being separate account investors to being opportunity fund investors to doing public security. So I think they like the breadth of the platform, but I think at the end of the day, it all comes down to your performance, how well you've done, transparency, making sure that you get out in front of them and tell them when you see problems coming or you have problems. And then a lot of it's tenure of the people, right? I've always been amazed when I would have a portfolio manager, let's say, in the seat for 12 years, and they leave or they want to do something else. Really, the pain you go through with the client to get them comfortable to change a person, even though they know the rest of the team. So a lot of it is just, really building the relationships and being really careful to stay on top of them, maintain them. You cannot take them for granted.
No, but I agree with you.
Right.
Performance is the best
So
marketing
it's the best,
tool.
it's the best mark. And, even though institutional investors will say that they're in it for the long term, when you have an open-ended fund, you literally are evaluated every quarter. It's actually awful.
Yeah.
Right? It just is, because it's like, how do you can't, you're in a world where you're competing against like 25 other funds, and you can't say to them, well, my income return, has outperformed all the Odyssey for 35 quarters now. Maybe you want to look at valuation. I mean, you just can't. So you have to just go with the flow and smile and, always have an answer. But it's tough.
Good. Randy, you just closed 500 million or so plus, you said, on Friday.
Yep.
I'm a happy investor.
Well, thank you.
In all of your funds. Talk about,
Why don't you invest in my funds?
it's all about
I've done this panel with you for 8 years. You haven't invested in my fund.
You never offered.
Well,
Talk about what are you hearing from investors real time, and
Well,
what's changed? You've been doing it more than 17 years. But
Yeah, we're different than other people on the panel because we only do one thing. We do one fund every 3 years. This last fund was totally re-up. We didn't have any new investors. We're basically raising money every day because every day you're interacting with your investors. It's a group of about 15 institutions and about 10 individuals. And for instance, we do 2 annual meetings a year. It sounds kind of funny, but we found only doing a spring meeting when we had the year-end results wasn't enough. People by the fall needed to have another meeting anyway, so you might as well do another group meeting. So we do
saves you flying to 30
saves
places.
us a lot of time. We do 2 large group meetings a year. We also, back 17 years ago in the first fund, we went to a no-fault divorce. So 50.1% of our investors can wake up tomorrow, not like us, and terminate the arrangement. So we didn't want to get into cause, no cause, supermajority. We just said, look, if we don't have a majority of the investors excited about us being the ones managing the resources, then they ought to get somebody else. And so because of that, we've developed pretty deep relationships. We talk frequently with our investors. As Pam said, you're quick to make sure that when there are issues, you get out with them, because nothing's worse than a festering issue. You need to, but you better have a plan about what you're going to do about it. And for us, it works well because it simplifies our life. We're not worried about multiple strategies outside of the fact that we have the 3 platforms at any time within the one strategy. And we're not raising money except for every 3 years or so, except for, as I said, you're really raising every day because the test is when you go. Is everybody still excited about being part of it? So it's a different approach, but we found it works well for us. And we also found that it works well for the group of investors. We're mostly mostly endowments, some foundations, and as I said, a group of very wealthy investors. You know, Steve's not quite at that average level, but you know.
I try. So, without a doubt, you know, investors these days are much more involved in our businesses and in what's going on. They are very engaged. This summer, I was in front of a global asset management firm. I was having a great meeting. At the very end, she turns to me, and Susan, we talked about this yesterday, and says, "So tell me about your ESG policy." And I was, you know, every bone in my body was thinking, is she kidding? She's talking about Edward S. Gordon? You know, I mean, no, I knew what she meant, and I can even tell you what the initials stand for, but it's sort of a very, how many people in here know what ESG stands for? All right.
For our attorneys, they better know.
Oh, yeah. Almost half. The question is, how many know, what to do about it? So Susan, let's just use ESG as an example, sort of the changing nature of investors and their desire to really understand the nitty-gritty of what's going on in your organizations and your approach. Take us through it.
It really has changed in recent years, and we actually, Hodis Weil does a survey of institutional investors' intentions as it relates to real estate. We do it with Cornell. It's a global survey. It's just LPs, and it's the largest survey of its kind. So we think it's got some statistical validity, but also it's ESG is one of the questions. So we've seen this evolution. 5 years ago, it was probably 13% of US pension plans, whereas in Europe it was probably 50% because it's been a much more focus. I would say today in the US, it's probably more like a third to 40%. Our survey's kind of be coming out in the next couple weeks. In Europe, it's probably 70 to 80%, but larger investors, it's probably over 75%. So there is much more focus on ESG policies. Let's just break it down a little bit in terms of just environmental. Are you is the manager incorporating sustainable practices in how you not just development but operate the buildings? And then it's also moving beyond just sort of better operations and better development kind of best practices, but are you incorporating in your underwriting, are you looking at perhaps the cost of insurance going up, especially if your properties are along the coast, or in drought-stricken areas. So there's if it's in an area where sea levels are rising, what's your remediation strategy? So how are you looking at it at an asset level? There's a really good paper that ULI did with Heitman on future-proofing real estate that gets into these newer ways of incorporating environmental and sustainable policies into your thinking about investments and how to not just acquire and underwrite, but manage on a go-forward basis. So I encourage that. But it's moved from a check the box. And if an investor senses that it's just a check the box and lip service, they're going to recognize that you're not serious. They also recognize what tenants want. And so it's also when you're trying to attract, it's all about talent today. Like real estate is a way to attract and retain talent today. That's what the millennials want to see, that they're working in a building that has natural light and air. And so it's really an important consideration. The other aspects, and one of the things that we're seeing in underwriting is when a manager goes and presents, takes out their pitch book and shows the org chart, and most of the consultants are asking this question. You probably have seen this too. Where are the women and minorities in your organization? And not just on the lower levels. They want to know that where's the diversity in your platform, and are they in the business of the business? Not just in capital raising or accounting, are they leaders in the various organizations or the various divisions of your organization? So it's gotten to be a much bigger issue. It's probably related to the Me Too movement, but I would say it's we had one manager who the investor who worked for, it was a woman who represented a pension plan, and she's like, "Where are your women?" And he kind of blah, blah, what can you say? Because he really didn't have any. And so then we go around once a month we go name by name, like where are we and what happened and what do we need to do? And when it came to this name, he's like, what am I supposed to do? I mean, she wanted me to hire women. And I said, hire women. It's not that hard. It isn't that hard, but it has to be a focus. Yep. And, but anyway, there is much more focus on all of the aspects of ESG today. And I think it's really, it's got to be, and I think this is one thing that we're going to talk a little about this operators versus allocators and these new operators that are trying to become fund managers. You can be a great operator, but if you haven't, you really have to appreciate that you're running two businesses. You're running an operating business, investing in whatever that real estate strategy is, but you're also running a real estate investment management business. You're a fiduciary. Yeah. And you need to internalize what it means to be a fiduciary, and that, the ESG kind of comes through in that discussion.
Yeah, I've been hearing on the governance issue. I mean, I've been hearing a lot about succession, planning. I was talking to a major endowment, and they said, their biggest issue is because they're long in the tooth with a lot of these managers, and they said, who's going to take over for them? Again, putting on their fiduciary hat, succession, critical. How do decisions get made? Who's influencing them in terms of ownership, et cetera? Toph, you have a social infrastructure fund. You face these issues. Yeah. What's been your experience?
Well, maybe just the whole ESG. I think it's interesting the effect these things are having in the business. So when you think about the ESG, sustainability, the governance, when you think about a lot of the diversity issues, this is adding a lot of cost-related items to the business. Great for the DLA team. I mean, you're seeing so much related to the regulatory compliance, et cetera. And it's interesting when you talk to investors, there's certain investors out there, and I don't want to pick on the category, but there's certain investors that want you to be the small fund manager, do a bunch of smaller funds, be the small guy in the corner or girl in the corner, but at the same time, you've got these challenges related to building sustainability policies, building a great diversity and inclusion policy. They're not giving you higher fees. So it's this challenge, and so that's why I think you're seeing such a big consolidation. But so what we're seeing on the ESG side is it really was driven by a lot of the Dutch investors, and it's really now you really can't get solid, what I would call institutional capital in a core open-ended fund or a fund strategy if you don't have a real sustainability policy. Mm-hmm. And it's peeling back the onion. It's not just sort of talking about it. It's really saying, tell me the actual cost-benefit analysis within the property. If you did a lighting retrofit, if you did some sort of, show me the benefit. What's the analysis? Did you put solar on your roof? What are you doing specifically? So we're having to invest a lot of money in our sustainability side of the business, and then you get a score every year, and they track you versus other people. So on one hand, it's great because it obviously is driving better performance of the real estate, and it creates a little bit of a barrier to entry to sort of new folks popping into the business because you're investing in this robust sustainability business. At the same time, the whole diversity issue, it's a tough one for our entire industry, and building a diversity and inclusion committees, structures, wellness. It's, I can't imagine back in the day if I went to Norman Perlmutter and talked about these issues. I mean, it would have been ridiculous. So to me, you're spending a lot of money, creating these structures, and then you take the third part, the governance side, and succession planning, and a lot of people really haven't thought through the succession side of things. I've spent a lot of time talking to people about that, and it's a question you're seeing more and more investors ask. Number one, they're focused on turnover. What is your employee retention? So you really have to put the numbers on the table. Why are people leaving? Where are they going? At the same time, okay, tell me what happens with the founders. How are you going to retain people? How are you moving equity to the next generation? So these are all happening, and it's really the push-pull because at the same time, you have to grow your business to deal with a lot of these issues, but at the same time, you have a number of investors out there that say, don't grow. And so on one hand, it gets frustrating sometimes.
No, it's interesting. On public company boards today, every single senior member of the leadership team has a succession plan. If I get hit by a bus, who's taking over, and are they ready, on a score of whatever, 1 to 5? Are they, 1 ready, or are they still a ways? Real important. Anything you guys want to add on this topic? I mean,
Well, what Chris was saying resonates with me because over the number of years, people do want those niche strategy-focused managers, and then they use this very broad definition of what they're looking for in terms of the regulatory and the reporting and all the rest. And so, and it's a cost of playing the game.
Yeah.
But I think that when you look at the cost over the last 10 years, I would guess that it's probably about double the resource in constant dollars that it was 10 years ago, just in terms of the level of reporting, in terms of the level of activity on the regulatory side, the registered investor, investment advisor piece, and I just think it's harder and harder for new players to break into the space, and so for those of us in the space, that's not always our issue, but I think it may not create as much variety and as much new blood in some of the opportunities to choose advisors going forward as they would like to see. And in fact, it's many of these policies that are going to prevent it.
If I could just add on it,
Yeah.
that's absolutely right. I mean, there's no question. We get like the Alan Formans of the world at Yale, who's one of the very sophisticated investor and a thought leader on the endowment side. But he's like, where's the new talent? Where are the new ideas? And it's really hard for a smaller investor or a first-time fund. We've done several, but the bar is much higher. Yeah. And when you talk about the issues you're talking about, Chris, over 20 plus billion versus talking, a first-time fund that has to be a registered investment advisor, really to be, even though I don't know about DLA's position, some lawyers are saying you don't have to be a registered investment advisor.
But the investors are saying you have to
the
be.
investors are,
Yeah,
exactly.
that's all that
The
matters.
investors are saying it's a good housekeeping seal of approval. It helps me in terms of my due diligence process. So you got to be a registered investment advisor. You have to have the same legal compliance reporting as if you were a much larger organization, and you'd have a pool promote today, which is a big factor because there was, before the global financial crisis, most of the structures were deal by deal payout of the promote with a clawback, and it was a way to kind of keep talent. And now it makes it much harder for these smaller funds. So there's structural things in the industry that are disadvantaged for the smaller players, and that's leading to the consolidation as well. And it's not the healthiest thing for the industry, quite frankly.
So let's transition a little bit and just talk about real estate and the fundamentals and the environment out there. Randy, you referenced earlier, it's late cycle. Okay, all of us have been hearing, it's 10 years plus, right, since Lehman went down. We've been hearing it's late cycle for the last, 3-4 years, yet the cost of standing on the sidelines and doing nothing is very, very high. So, what's kind of your view? What kind of keeps you up at night? Where are you seeing opportunities? And how does the current environment, because I think history is an important lesson here, how does the current environment really compare to sort of the peak pricing that we hit in 2007? Is it different this time? Are we in this, I think in the previous panel they talked about, Japan kind of thing, steady state, even though obviously our demographics are different.
Well, obviously in 2007 we didn't have free money. And
right.
And I think the real big difference this time is the activist Fed. Without the Fed having as aggressively managed interest rates as it has, I think we would have had a recession a while ago. And I think that's the hard part now to predict, because who knows what is going to change there. But more importantly, we don't have a roadmap for getting out of these types of cycles. We've never, as far as I can remember, been in a cycle where rates have been driven this low, and we've basically sustained what's now a relatively low growth economy through the use of free money. And negative money in some parts of the world. So I think that as investors, and obviously you made the comment earlier, real estate looks good compared to X, Y, and Z. Now, are X, Y, and Z grossly overvalued, so real estate is too? Maybe. But it is in the mind of a chief investment officer at a large pool of capital. They're trying to figure out they need to invest somewhere. And for them, it is a comparative exercise. They are looking at the choices they have. And so we've heard multiple times from institutional investors, particularly on the lending side, where they're being pushed to make loans because the real estate loans are perceived by the CIO at that large institutional player as being better priced and more secure than some of the alternatives they could go after. So I think the thing that we all try to do, I'm sure, is try to do a lot of sensitivity testing about how wrong can we be on certain assumptions before things start to get nasty, as in you might lose principal. And we have the advantage of being a 10 to 12-year holder, so we're not worried about having to sell in the next down cycle. But we do worry, obviously, about debt. So we're doing a lot of 10-year fixed rate debt because we think that's a good insurance policy. In the Great Recession, we had a lot of 10-year fixed rate debt, and it meant that we didn't have maturities and didn't have those issues. It did mean on the other side, though, from a fair value point of view, we did have some negative impacts, but from my point of view, the insurance was worth the price. So, because if that's the difference between a good deal and a bad deal, you probably shouldn't have done the deal in the first place. Because if you underwrote it on that kind of cost of debt, then you should not be terribly surprised. So I think it's just a time to be thoughtful, to match your asset and liability sides of the balance sheet. I think it would be perhaps a good strategy in retrospect if you went floating at this point, but I think you're always running the risk of the black swan event. Something comes along that changes that dynamic. I don't think we're going to get a huge development opportunity here for a while. I think we're pretty well supplied with most product. I think the earlier panel talking about the fracturing of fractionalization, whatever they called it, of real estate, we're getting much more effective at getting much more intensive use out of existing assets in all parts of the economy. And as a result, I think some of the natural growth we historically would have seen, and I would say perhaps the one exclusion of this is the affordable housing side, is not going to be as strong as historically it's been.
Good. Pam, what
I mean, I think right now it's hard to manage portfolios because a year ago we sat down and said we thought the 10-year would be at 3.25 to 3.5 by year end. So, we told the portfolio managers, go through, evaluate your portfolio, evaluate your entire portfolio, foundational assets you think you're going to hold, go put your debt in place, right? So they do that, and then the 10-year drops, and we take a hit on a mark-to-market, and it's just very difficult to understand how there could be such huge swings in the debt markets in 1 year's time. When you take a look at go-forward returns and you look at just GDP growth, right? There's very little that's going to be forgiving in terms of performance, right? So you have to have really active asset management. You really have to have people on their toes. And a lot of young people have never been through a crisis, right? And so a lot of times being spent on training, and then you combine it with the fact that you're dealing with rent control, right, in California, rent control in New York, energy regulation in New York, local law 97, and the fines you're going to get. So just trying to stay on top of all of the things that can affect your investment decisions, whether you're looking to buy assets or sell assets. I just feel like there's so much data coming at you that you constantly have to be on top of it, in addition to all the ESG things we talked about.
Yeah, I think that's a real risk. Kathleen on the other panel from Blackstone mentioned that as the thing that keeps her awake at night, sort of the rise of populism. Mm-hmm. And it's not just the old rent control that we saw in New York and we're seeing in California. Now you're starting to see it on commercial properties and how they're being taxed in California. Mm-hmm. And so this is a direct threat to our industry and the economics. And so I wonder how, as you're trying to de-risk investments, how you think about that. I mean, Chicago, I hate to say it, but it's a little bit of the red line poster child mm-hmm. for a lot of institutional U.S. investors who say, hey, Fritz Kagi, the new tax assessor, I don't want to catch a falling knife. Let's just wait for the 3-year triennial to be done with, and let's just see how bad property taxes end up being. I mean, that's just one element. I mean, so...
In California, you could go the same way.
Yeah.
Overturning Prop 13 for commercial property.
Right. What do they call it? It's like split something?
Remember, it's split initiative or...
Well, I mean, I think, managing risk is the big theme because, none of us know where we are. We've been talking about the cycle forever. So, one of the things we really talk about is how do you manage risk? And I think a lot of people are chasing yield now, and they're taking risks that, it's amazing that people aren't sort of peeling back the onion. So how do we think about some of these things? It's taking the asset classes we might be in that we think already are defensive, but how do we sort of manage risk further? How do we do more work? You mentioned our social infrastructure fund. We're spending a lot of time with universities and hospitals on their deferred maintenance, working with them on their campuses with different assets that they might have. So I think it's enhancing the credit profile of our assets, whether it's medical office with health system, whether it's instead of just doing off-campus student housing, it's now working on campus with these groups. So I think it's really sort of thinking through your portfolio and how can you manage the risk to reduce that volatility. But it's very hard to say, I'm going to stay out of Illinois, I'm going to stay out of California. I think you've just got to look at the assets you're going into. And we just did a development in Lincoln Park, a senior housing deal right on the children's sites. I'd never want to sell that. That's going to be fantastic.
Right.
So I think it's trying to find, someone talked about quality. I think it's focusing on great operating partners, great quality, building a diverse portfolio, and then really thinking about that underlying risk. I mean, people are taking entitlement risk, cost overrun risk, recourse risk. And really, when you start peeling it back, it's amazing the type of risk. So that's what I'm seeing that's sort of similar to what was happening in that earlier period of time, is there is a lot of risk. There's a lot of developers with a ton of recourse, a ton of pre-development exposure in a cost-raising environment. So I'm starting to see a lot of risk in the system, and we'll see what that means. But hopefully for folks like us, hopefully that will create opportunity.
Yeah. No, I think thematically we've been hearing, 12% returns with low risk makes you a hero, and that's really a great place to be. We have a few more minutes. We could jump on a bunch of things, but I really want to talk about consolidation in the industry and specifically the investment management business and what's been going on. And we have a bunch of different perspectives. And maybe Susan, since you do advisory work in this area, maybe talk about what you've been seeing. We've been talking about how high the bar is, but getting access to capital, it just seems you have to be bigger. What's your thoughts?
And we're seeing, what are the motivations for a manager to be considered being acquired or to merge with someone else? I mean, because sometimes it's succession planning, right? That it can be part of that, but generally it's access to a distribution source. Do they have better access to capital than we do? Because it's such a time-consuming aspect of our business, it keeps us away from our day job. So if there's that kind of synergy, or is there a product adjacency? This concept of doing more with fewer managers. Do we bring, if I've got a debt fund that could be a complementary skill set to what Randy does, that make sense for us to get together? Because I'm a debt expert in senior housing and manufactured housing, for example. So it's kind of trying to marry complementary strategies. From the investor perspective, what they're going to want to know is who's remaining, what kind of what kind of contracts do they have to stick around? Is the decision-making process going to change? Is the strategy going to change? Is it going to go from being and we've seen this a lot, go from being a client-focused firm that understands that the capital is the lifeblood of the company to a product-focused firm where there's churning out product after product. So those are the kinds of things, but we are going to see, the industry is much more mature. We are seeing this consolidation in capital going to the 50%. The statistics are with an order of magnitude, kind of 40 to 60%, depending on what year it is, goes to the top 10 managers. That makes it much harder and is sort of driving the consolidation for everybody else.
Pam, you guys are part of a big
so I look at it
international,
and
global.
just being able to respond to client requests. So we have an RFP in front of us right now. It's 26 pages long. And if you're not big enough to afford an unbelievable technology platform to gather data and slice and dice it, which we've been fortunate, we invest a lot of money in a technology platform. I'm able to go online, I can get data on the portfolio, spend time analyzing it, but it goes beyond that. I mean, this RFP asks for us to develop a model portfolio and then tell them how that portfolio would have done over the last 10 years, to go back and look at, lessons learned from the worst thing you ever did. I mean, it just goes on and on. And I feel bad because I think if you are a smaller organization, I don't know how you answer that question, right? Right now, I have like 7 people working on it, including myself, because it's asking a lot of stuff about, the history of the firm and legacy issues or questions. And I just don't know how people compete. We have 25 people in our IT group, and they service pretty much globally. But I think Blackstone has like over 100 people in their technology group, and they dwarf us. But I think it's kind of unfortunate because, like you said, a lot of clients want smaller firms who can be nimble to be able to provide alpha, but then they're like, but you've got to have, all these other things, and all those things cost a lot of money.
So you guys brought in a strategic capital partner a year ago?
We did?
Yeah. Give me the business reason. I know the economic reasons.
Oh, come on, Paul. I think that, this business is really, it's the people in the organization, and there's a lot of pressure. Even I had it when I was in my mid-30s of, hey, I wanted to go branch out. I want to do something on my own. It's very hard to kind of create that right retention with your organization if you're not thinking of ways to push economics down to the next stream. We had a family partner. We wanted to replace that family with an institutional capital source. And it's fascinating to me how many different alternatives to this mousetrap there are now for succession. There are groups that are doing minority deals. There are groups that are doing revenue share deals. There are groups that are buying 100%. There are groups that are buying 75%. So I think people are attracted to the capital because the valuations are at a good place now. But then it can allow you to do certain things. So for our issue, it was not distribution. We were not looking for a distribution partner. We were looking for someone that gave us our autonomy, but helped think about moving the economics to the next generation. So I've literally talked to a lot of managers, and the first thing I say is, what are you trying to solve? Are you trying to raise capital? Are you trying to buy out a partner? What's the motivation? Because everybody's exploring it, everybody's in discussions about it, everyone's trying to solve it, and it's this challenge. It really comes down to the people side of it. The nice thing is the investors, look at you. You call them up and you tell them what's going on, and they say, okay, tell me your story, tell me why it's great for you, tell me why it's great for me. And they've heard it a number of times, and you're not seeing situations where investors are saying no to it. It's kind of part of the industry right now. And frankly, it's what's interesting is, you're talking to a lot of consultants who are going through the same issues themselves. Mm-hmm. So,
Yes.
sort of you got the, I'm going to talk to a consultant who's gone through like 3 of these. So anyway, I think it's going to continue to happen now. You're going to continue to see the consolidation, and there's a lot of different structures. There's a lot of creativity out there. So I think it's great for our industry.
Excellent. I promised Shelby Pruitt I would do the speed round. So I want to do this real quick, and then we'll open up for questions. So down the line, Randy, do you expect a recession by 2021?
Maybe.
Maybe. Yeah.
Nope.
Yes.
All right, split vote. Are you more concerned about inflation or deflation?
Inflation.
Deflation.
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 Okay. 10-year Treasury today, roughly 1.7%. Up or down a year from now?
Little down.
Little down.
Little up.
Up.
Man, another split vote. Foreign capital flows to real estate, up or down a year from now?
Up.
Modestly up.
I think the same.
Way down.
Really? Okay. Real estate cap rates, probably tracking interest rate answer, up or down a year from now?
Depends on the category of asset.
Yeah.
Yeah.
Up.
Up, thank you. Secondary or primary markets, which is a better value today?
It's so deal specific. I can't.
I would say knowledge-based secondary markets.
And I would agree with that and just say that in my mind, it's all about liquidity. So it doesn't matter how much additional return I get if I can't get out.
I think secondary, looking for places that have, education, universities, health systems, et cetera.
Core real estate or mezz debt, what's a better value today?
I don't
selling my own books.
participate.
I'm selling my own books.
I don't participate in either one.
Randy, you're not a politician.
There's no investors in the room. That's the beauty.
What are your returns now on mezz debt?
10 net.
Mezz.
I mean, again, it goes back to
I know
property
you-
type market, sponsor, but I would say mezz debt.
If it's your fund, I'm in.
All right, I'll invest with you. Favorite real estate asset class?
Right now, it's the near airport parking for us.
I'm big on life sciences.
I say multifamily.
Yeah, we're doing a lot of stuff in life science, behavioral health, things like that.
Good. WeWork. We almost went the whole session without mentioning them. 60-minute expose or IPO? Which is more likely?
The IPO and then the 60-minute expose.
I think flexible workspace is here to stay. WeWork, I don't know if it goes public.
And I feel the exact same way.
Yeah, so.
Okay, 10 years from now, who will have the most real estate AUM? Blackstone, Brookfield, or Hines?
I'd say either Blackstone or Brookfield.
I'm going to say Brookfield.
And I'm going to say I don't have a clue. A lot happens in 10 years.
Come on, there's a layup for you.
Harrison Street.
There you go. That's what I want to hear. That's what I want to hear. Okay, what excess or bubble will trigger this country's next economic downturn? Will it be the I'm being George Bush here, proliferation of sub-investment grade debt lending? Will it be something geopolitical, like Brexit or Iran? Will it be domestic political gridlock? Will it be a tech VC bust or something else? What's going to bring us down?
It's normally a combination of excessive leverage with a shock to the system that it can't withstand.
Yeah, I think geopolitical.
I think a tech bust.
I mean, I went to Roanoke College. It's a tough question.
His multiple choice.
D.
D. Other. Okay.
All of the above.
All right. We got to talk about 2020. I'm sorry we almost made it through without it. But what do you think the biggest campaign issue is going to be in the presidential and congressional elections? This is another multiple choice.
All right, good.
I'll start with you. Climate change, immigration, the economy, character, or something else?
Immigration.
I think immigration.
I would like to say climate change, but I don't think it's going to be. I think it's going to be character.
I think it's healthcare.
I'll
Yeah,
vote
I would agree
That
with
healthcare,
healthcare,
that's a-
because you
that's a
didn't
good
put that
one.
on there.
That's
Healthcare,
other.
I would
That's
say.
other.
It's definitely
Other.
healthcare.
Other.
I vote for climate change. Who'll be the Democratic nominee?
And you're going to vote for you're going to vote for whoever it is. That's the problem. Biden.
I think it's going to be Biden.
I think it's going to be Biden.
Same.
Yeah. Nick Burns gave a good endorsement last night.
They did.
Will Trump get reelected?
Yes.
No answer.
Lord, I hope not.
I think if Biden's the candidate, probably not.
By the way, should anyone in real estate care?
Yes.
Yes, yes, yes.
Good. All right. Who's going to win the World Series? We got to end this.
I don't know. No idea. Cubs are out, so I'm bummed.
I don't have a clue.
I know.
I know you want to hear the Yankees.
Come on, I wanted the Yankees. It's been a decade. Thank you.
Question?
Thank our panelists. Yeah. Do we have time? 2 minutes. I'm sorry. Do we have questions? I meant. Yeah, it was on my list. I just figured people were tired about it.
There was a lot of interest and enthusiasm, but not a lot of capital's been raised, which surprised me because I thought that it was a great idea. But I just think the rollout was so tortured and complicated, and it was hard for people to kind of gear up for it. So I think it's kind of petered out. There are going to be some success stories, but it's not going to be the opportunity we all thought it could have been.
We've done 2, and I just think the underlying fact pattern is go in if you feel it's a great real estate investment.
Right.
And the rest will take care of itself. If you have the right kind of patient money, it's wonderful. I think the government is giving you a gimme here in a lot of markets. Places like Portland or Nashville, where they were just very creative in designing these boundaries. So I think you just need to dig in and try to find specific opportunities that make sense with the right sponsors, obviously. Other questions for these great panelists? Yes? No? One more.
Your question about should
John.
panelists care about who wins the election? You know, said yes. Follow up with why.
Good question. I would have said no, by the way. So I'm the minority, but they all said yes.
What I'll say is that some of the alternatives in the Democratic Party will fundamentally destroy capitalism as we see it, and will mean a lot of what we do won't be needed.
I agree with that.
You know, yeah, we're seeing the impact on populism in real estate. We're seeing the impact of the trade wars to some extent in real estate. They've just been manufactured. The deficit is a huge issue, but we feel like it's not an issue anymore.
Plus labor is a huge issue.
Labor is so. I just think that there are.
It can go either way, though. I mean, we saw with the Obamacare, our medical office was an unintended consequence. It was a really positive in terms of more people, doctor visits. So it can go either way depending on your asset classes.
Great.
But the point is, you care.
Again, thank you guys for being a great audience. Please thank our panelists. Great job.
Nice meeting you.